I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm pumped for this episode. We are talking about a group of companies that, well, have driven the market, have made most people listening, have made us a fair bit of money.
Yes.
And some of might be some of the biggest companies, but they're also some of the most innovative and exciting companies in the market.
That's it. And we have an expert here to help us talk through some of the companies that are in the FANG Plus ETF. It is our pleasure to welcome Zach Riaz to the studio. Zach, welcome.
Morning, gents. Thank you for the kind introduction.
So Zach is the co-founder of Banyan Tree Investment Group, a manager and advisor on $3.5 billion across equity and multi-asset strategies. So plenty of experience. And we're going to be picking Zach's brain on all things tech stocks that Ren was just talking about. So this is part of a series with ETF Securities and about their FANG Plus ETF, which is an equal-weighted ETF providing access to 10 stocks: Baidu, Alibaba, Alphabet, Apple, Tesla, Microsoft, Nvidia, Amazon, Meta, and Netflix. Zach, all the big hitters are in there.
That's where all the innovation is coming out of.
That's it. So let's kick off about FANG Plus. So for people unfamiliar with the term, let's start with equal weighted.
Yeah.
What is equal weighted and how does it differ from market cap weighted?
Well, as the name suggests, equal weight is essentially every stock, every company, regardless of its size, risk, is positioned in the index at the same weight. Essentially average. And obviously market weighted is where the size of the company, and invariably that also means the risk associated with it, gets taken into account. So market cap is essentially, your price times the shares outstanding. So the bigger companies can drive the index. Now, how you got to think about it is, I think it's very relevant in some parts of the market, especially as you start becoming a lot more consolidated in terms of the indices. You look at the Australian market, right? Your big drivers are your banks. Your big drivers are your materials. So if you're invested in a market cap weighted approach to those index, then you're really taking a bet on the big banks and you're taking a bet on the materials and what happens there. So what we tend to do is, if we're less positive, or how we advise clients, if you're less positive on those big sectors that invariably drive the index, then you go more for an equal weighted and average. And what that also means is you get a nice breadth of exposure to economic sectors and industries, but also different business growth rates, right? So there's smaller companies by their very nature have better growth rates, but they're more risk. And so in really vibrant, high growth, high economic growth environments, you probably want to be equal weighted because the big companies tend to grow slow and there's a gravitation to the smaller companies. But similarly, in a more volatile or defensive style market, you want to gravitate toward the large companies. So that's where the market cap weighted sort of index approach. You look at the FANGs, right? Google came out with an extraordinary result that not too many people were calling it. It came well above consensus. And whilst the rest of the market are down, it took one stock for it to push back into positive territory or thereabouts. And we all know over the last 10 years, as these guys have enjoyed the structural tailwinds behind from the innovation disruption, they've become a much larger part of obviously the NASDAQ, then also the S&P 500. It's how you want to play it. There are parts of it. And, you could take a satellite plus approach as well. You go, well, the index has been driven by these guys really. So let me invest in them. And I know they're good, liquid, safe companies, then I'll take risks with satellite positions, and which can be in your slightly more speculative.
I feel that equal weighting particularly matters with this ETF because Baidu's 50 billion market cap and Apple's 3 trillion.
Yeah.
And so if you want Baidu to have any effect, it's not going to if it's market cap.
Well, it's going to get drowned out, right?
Yeah.
And that's right. So, that's the other thing. Baidu, not too many people probably know about Baidu just yet, right? So, and I think that's why ETFs like this, with an equal-weighted approach, are also introducing new exposures, not just in terms of the technology, but economic exposures in terms of which markets and which consumers they target. Yeah. So that's a really good example. Exactly right.
Yeah. So there's 10 companies in this ETF. what ties them together, and I guess what separates them from other sort of tech names in the US and China?
I mean, if we step back and take the premise behind the ETF and the holding, it's all about innovation and disruption. And I think that's essentially what ties these companies together. They're still innovating. And I mean, they're multi-trillion-dollar companies, but you just see they're still, and we'll get to it a little bit later, they're still innovating in AI, machine learning, autonomous auto-driving cars and whatnot. And they just have the backing of free cash flow and very strong balance sheets. I think I was looking at a figure, the top tech companies combined have close to $1 trillion on their balance sheet in terms of liquid cash, right? And just to give you an example, Apple Watch went from nothing to $3-4 billion in revenue, right? And, so these companies have the ability. So I think bringing it back to what the core premise behind this ETF is and the kind of companies that they own is that innovation and disruption. I think the other thing that probably differentiates this a little bit is it is at the larger end of the market cap. They're liquid. They're well-known companies with generally good earnings behind them. So they're not risk, so you're not taking too much speculative risk in this. In market sell-offs, I know the first month has been a little bit different, where it's been driven by rising yields. So the tech stocks have come off, duration stocks have come off. But generally, because of the defensive nature, they tend to hold up much better and people gravitate towards US equities and stocks with good earnings. So I think what the differentiation is also around governance. These are listed in the US. Even Baidu and Alibaba, these are ADRs. And so there's a obligation once you're listed on how you approach governance and whatnot. I know there's a lot of conjecture around that right now, around the ADRs as well. So there's big differences around that as well.
So we recently saw Twitter removed from the index and replaced with Microsoft. I'm surprised Microsoft wasn't in there to begin with.
Yeah, that's a good substitution, I think.
Yeah, massive oversight. So that begs the question here at Equity Mates. We've been throwing it around the office a bit. When will Netflix get the flick? And so for context for those listening, it currently has roughly a market cap of 182 billion. The next smallest market cap in the index is 600
for American companies.
For American companies,
yeah. So Netflix is going through a period of influx with its earnings. Its member growth certainly disappointed. I mean, so bring it back to, I guess, how the actual ETF is set up. There's an investment committee, from my understanding, that looks at the market, that considers liquidity, that considers the market cap, and then makes a decision based on some rules-based numbers as well as to what gets included. It is still at their discretion. Now, back to the original premise, why would a company be included in this particular ETF? Disruption and innovation. So if I had to take either side of the coin, let's take the reasons why you would probably look to remove it is the innovation around streaming has largely played out, right? And
it's mainstream.
Netflix has absolutely, exactly. I mean, for the last couple of years, I think the eyeballs have moved away from TV, your linear programming, to non-linear programming like Netflix and whatnot, has probably largely played out. TV has lifted its game as well. So I think that disruption piece for Netflix is largely done. Now, they may reintroduce disruption innovation by maybe acquiring a gaming company. Microsoft has gone out and do that. They may try to move in other areas where they're disrupting more. But right now, it's a land grab for Netflix, right? And, to be honest, most of us have Netflix.
Yeah.
So, and the other part of Netflix is that, quite simply, is that they've got to continue to produce good content. So you've got to continue to push that out, right? And you guys know that, right?
Oh, yeah.
The other, you can't stop, right? I mean, it's the funny thing is, right? I speak to some social media influencers who are starting to get up and they always say, I just got to come up with content. I've got to come up with content because that's what you think about, right? But taking the positive side on Netflix, it has a very strong market position. It's raised its fees as well. So that's earnings. And again, right now, its cash flows, free cash flows are struggling because it continues to invest in this business. But like I said, the company is so big that it can go out and, approach innovative markets, whether it's, side markets, alternative markets. So yeah, I think it's on the question mark, probably for the investment committee.
Big time.
So Zach, at Banyan Tree, you advise a lot of clients on how to build portfolios. When you think about a ETF like FANG Plus, how would it fit into a portfolio?
Yeah, so I kind of touched on it at the start. I mean, we know it's concentrated. We know it's giving you the exposure to the largest liquid companies that are still disrupting and innovating. And the interesting thing is they're still fairly safe companies. I think the other point is that, back to the Netflix point, there are other companies that are knocking on the door to be entered into this ETF. So, think about the innovation that's going on there. So I think how we use, or we would consider using this is basically, look, that core plus satellite approach. The index has essentially been driven by these large companies. If we look at their recent results, they're still kicking goals, as shown by Google and whatnot. They're going through a bit of period of margin compression and, due to labor costs and whatnot. Some of that is transitory. Some of that may be a bit more long-term, but they're still growing top line and earnings at double digits, right? That's pretty attractive. And especially when the re-rating has already happened. So we would take the approach that, have this potentially as your core, because it invariably gives you the exposure to the market anyway. And then you take other satellite approaches to it. Or you can just go, look, I'm a long-term investor. I expect the investment committee to keep introducing innovative disruptions. I know that's where the place is to be. I was just reading the latest KPMG surveys from 2022 as well. Management teams are only thinking about one thing: how do they actually disrupt and innovate their own businesses and sectors? So in come these tech stocks. But yeah, that's how I'd largely use it.
And then, so how do you think about the fact that a lot of these companies are $1 trillion or more, like massive, and still pumping out reasonable growth? But I guess at $1 trillion, you got to ask, how do they get to 2? How do they get to 3 trillion?
Well, you didn't have to ask Apple. They just blew past it.
They just threw past it.
But yeah.
So how do you balance that with thinking about, looking at other ETFs or opportunities that feature those smaller tech companies that have that growth coming through?
Back to the earlier point that you can take that satellite approach. You can have these guys as your cornerstone and know there will be changes within that will generally lead to higher earnings and disruptive innovation outlook. But then you can mix that up with other tech stocks. But the whole notion around that is, if you look at the recent sell-off, some of those tech stocks are down 50, 60, 70%. Now, that's not to the risk liking of too many people, So, and mind you, a lot of people have made a lot of money out as well on paper. But if you followed it up and down, then, so I think you got to keep in mind how much risk you're willing to take on. But that satellite to core approach is probably the way to go.
Yeah. I think, and I haven't checked all of them, but I think all 10 are profitable. Does that sound right?
From memory,
right.
I think, yeah.
Yeah.
I think some of them are hitting their earnings numbers. Yeah. So bottom line, may be different story. Yeah.
Yeah. And I guess that's the difference between these companies and like the Pelotons and the Zillows and those kind of tech names.
And it's an interesting point about earnings and how much reinvestment you do. You look at Google and Amazon; they're investing a lot. Amazon's investing a lot in its fulfillment centers, right? Because it knows it's number 3 player in online shopping globally, number 1 in the US, right? Now, for it to reach a higher positioning, it needs to have same-day delivery, has fulfillment centers, it needs to have presence to be able to deliver, same day or a couple of hours delivery. So there's still a lot of investment that needs to go in this. And when you see, and whether you agree with it or not, when they see the growth trajectory in front of them, when they see the change in consumer behavior, some of these guys are saying, I'd rather not bank in the bottom line just yet, and I'd rather reinvest. You look at Google right now, Google's income, Alphabet's income is driven by its search. Solid business, in fact, kicked goals, but its cloud business is still negative. And, it's up to, I think, $22 billion quarter revenue. They see such a long growth runway there. As investors, if you're giving me a good rate of return on my investment, I want you to keep investing rather than give me dividends. You've got to practice that with a sense of caution as well. But like I said, there are companies, small speculative stocks, that use that excuse to keep pumping in, and maybe the future returns are not likely to eventuate. So that's where you still go to these large companies. But there's that reinvestment question is also important.
So, Zach, we've briefly touched on a few of these companies, but we love going deep on a stock here at Equity Mates. And so we'd love to choose 2 of the 10 companies in this ETF and go a little bit deeper on them, cover what the company does, where the company sees its future and where its future growth coming from, any key competitors, and then, because we want to play both sides here, what the bull and the bear case may be. So dealer's choice, happy for you to choose the companies that excite you the most. Is there one in particular you want to start with?
Well, let's talk Amazon and Google, right? Two, and I think everyone knows them. So, but what I want to do is, as any investor, especially professional investors, these companies are so wide ranging. You want to just bring it back to what really matters, and essentially that's what you're asking about. What's going to be the catalyst for these guys going forward in terms of a returns perspective? So, let's take Google first. Search is great. Absolutely killing it. And what they're doing with AI, machine learning, and just the way they're bringing new products for you and I to promote so much more seamlessly, right, across their different platforms and properties, it's amazing, right? So one AI, I don't even have to put in the keywords and bidding for it. I will tell them, this is what I want. I want return on investments, or I want return on consumer eyeballs, or whatever it is, and it will go bid across platforms, right? That kind of innovation. That's why they're kicking goals with their search. But what's the kicker here? I think one of the kickers for them for Google will be YouTube. Yeah. What the valuation on that is. YouTube was bought for $1.6 billion. Back on the envelope numbers, currently $300 to $400 billion. That's about 15 years worth of work, right? It's not bad, right? He's looking at me disgusted.
There was some stat that it was like Google now makes $1.6 billion in revenue every like 3 weeks or something.
You got to be crying if you're the sellers, right? But I'm sure they.
Well, yeah, I'm sure they're probably billionaires.
But what? Again, it's a great example of what a large company with great market position was able to bring a really good idea and really put a rocket underneath it. So what the value of Google, YouTube is important. How they can increase the memberships, how they can increase advertising, that cross-pollination between search and stuff, that seamless pollination is another growth driver. I think there's conjecture around, we're talking about antitrust issues. To be honest, if you broke up Google, some of the parts are looking pretty decent as well, to be frank. So that's one for Google and YouTube. I think, again, I don't think I'm telling you anything rocket science. I think this is out in the public as well. The other part really is cloud. So they're doing really good kicking goals in cloud. They're picking up some really big names, and also the run rate, they're still making a loss there. I think that's
they're quite small relative to
exactly AWS and Microsoft. Yeah. But that, from my perspective, is still rising tide lifts all boats. There's a lot to go on. There's over $1 trillion in IT spend. There's still a lot to go in infrastructure as a service, and which is probably becoming a lot more commoditized, but platform as a service, right? And when you seamlessly connect your other properties and whatnot, and ability to give you a much broader view and target audience, it's powerful. So I think what Google Cloud can do from an earnings perspective, and what YouTube may do. And then again, just the AI machine learning there to making that search seamless, it just blows your mind. So that's the key catalyst for me for Google. Like I said, growth rate will moderate a bit, but you're still hitting those mid-digits, double-digits numbers.
Is there a bear case for Google?
Yeah, absolutely. Absolutely.
I'm struggling to find it. True.
Okay.
I hear Ask Jeeves is trying to get a bit of a return back.
Ask Jeeves is now just
Jeeves?
Ask. No, it's Ask Group. Yeah.
So the bear case is this, right? The bear case is that the cloud becomes so competitive that they don't make the earnings and the margins. So AWS is expected to reach 35 margins. That's what you probably, also sort of expect over time for Google. So they don't hit the margins. Disappoints, right? YouTube, how quickly innovation is happening. Some guy comes up with another platform and eyeballs and everything goes there. Again, the eyeballs tend to just, are either being captured. They're in other places, but Google and Amazon probably buy it out anyway. Yeah. Exactly, right? Yeah. So, and the other bear case is, I think what's really important to understand is, what was the winner of last year may not be the winner of next year. Just look at who were the leaders in early 2000. It was Microsoft, GE, the other big names. Yeah, some of them are not Exxon. Some of them are not even here, and some of them are going to probably completely evaporate, right? Yeah. So I think that keeps me up at night, that how can Google's story really fall off?
Yeah, it's tough. It's hard to think like that with Google. It has 98% dominance in.
Well, here's a bear case. We no longer need internet search because Elon Musk puts microchips in all of our brains, and the search functionality is no longer needed.
But it's searching through Google to go into our brains.
Well, if you believe some of the conspiracy theorists, I have had my jabs, and apparently I can talk to Bill Gates through through the chip in my.
Yeah, but it's through Bing, so it doesn't really work.
Half of the searches don't even come up.
Nice.
But yeah, look, it is an issue. And the other point is these guys are competing for talent. Talent like yourselves are saying, I can do this on my own. I don't need to do this. So that's a big thing. And in fact, the other company, Amazon, that's one of the sore points, $4 billion extra in the quarter because they couldn't find people.
Wow. Well, they just upped their base salary, I think, from base salary cap from 229 to almost 500K.
Yep.
Like their base salary cap was 229,000 across the company. Okay. And they've now upped that to $500,000.
The amount of money. My biggest regret is I didn't study computer science.
Well,
I'll take that to my grave.
Let's talk about Amazon then. Yeah. Similar case. What's going to take it through the next trillion?
Yeah, look, I think with Amazon, the one thing they started splitting out is the advertising piece. So that's about $9 billion. That's important. Again, they've realized they've got all these properties and they've got these 3 third-party sellers and they've got these market positions. They can, again, seamlessly include AI, ML, and innovation to help these guys promote their products, their services, and that's something that's a real growth area. And the other part is the growth part is cloud. They're trying to move away from just providing a basic infrastructure, which will become commoditized, to becoming a more platform that equates to a higher gross margin. And so look, I think one of the positive cases for Amazon is people are looking for that cloud computing business to register about 35% in margin as it gets to maturity. So now the downside case really is that, look, these disruptions and the pressure on wages is more elevated and remains elevated. I mean, there's a really good example they gave during the recent quarterly update was that, because of Omicron, they had people getting off work who couldn't come back until they got a test. They had to get more people in. So they were paying 2 to 3 times for the same position. Right. And now you'd think that should settle down, and they're saying that. But, as you just said, they've upped the ante on wages in general, right? So, and they've got away with paying pretty attractive rates. So it's the cloud. It's what can happen with, obviously, the advertising. And then also, there are some markets that they're, in terms of the 3P, the products, they're big in retail, e-commerce and whatnot. In entertainment, apparel. But there are other markets that they're sectors and industries they're not big on, like food and whatnot, which is a growing category. So those are the key things. And, the bear case is really the opposite of that. Again, you disappoint. You're already $1 trillion company. People start moving to slightly other parts of the market.
The other question, I guess, is the Jeff Bezos transition. So, he was probably the best business person of our time.
Yeah.
Just taking retail and just turning it on its head. But he's now leaving the business and seems to be living in a gym.
I was just going to say.
You've seen any
very
recent
buffed.
photos of him?
Well, you know why he had to buff up for all the obvious reasons, right? He's slightly got a new equity partner.
Yeah.
But Andy Jassy has taken over, who started the AWS business.
Yeah.
How do you think that transition is going to go when legendary founders leave companies and hand it over? How does that go on historically?
Yeah, it's a very good question. I think it's important. Now, generally, for most companies of a reasonable size, I think not enough credit is given to middle management and the second tier manager above the CEO or the founder, right? Absolutely no doubt. The founder brings vision, energy, and motivation, and everyone follows them. But I think the execution part, which is the most important part, I want to put people on the moon. That's great, mate. Look, all right, now fine, give me the game plan, right? So Elon Musk is great at going, we're just going to do this. And he's smart enough to start the process but then you've got people coming in. But what we'd like to think is when you're a couple of $1 trillion companies, you've started to prepare people in those roles to take over, but because they're already doing the executing. Does a bit of the vision fall away? Perhaps. But there's still other personalities that can pick up the pace. So we think it's big enough for it to just not just fall off. But some of these guys are very capable in the second tier and third tier management. And I think it's been well planned. And look, at the end of the day, some of these founders are still very much exposed and leveraged to how the equity prices and the performance of the company goes. So
I feel like the whole vision question can't really be asked with the new Amazon CEO, because I think the story, and correct me if I'm wrong, but the story was they have Bezos had someone shadow him for a year, and like every year was someone new. When Andy Jassy was shadowing Bezos when it was a retail company, Andy had the idea of selling their excess server space and started Amazon Web Services. So in terms of vision, like it wasn't Bezos that came up with that idea.
I mean, and this is the thing, right? Like I said, I want to go to the moon. Well, let's not go to Moon. Let's go to Mars. So it's the people that you surround yourself, right? And Amazon, Google and Apple, honestly, the guys at the top were really good at selling the vision. There were some really smart guys below, the Apple founder. There's some really smart guys below the Google founders, right? So you got to give credit there as well. And you agree that I think it is a brains trust that is coming up with this. And, like I said, at the end of the day, vision is one part, execution is another important part. And as investors, we're more interested in execution.
There's some very successful transitions. Tim Cook taking over Apple has been trillions of dollars worth of success. Eric Schmidt taking over Google, again, like incredibly successful. Steve Ballmer taking over Microsoft, not so much. There's some funny stuff there.
Yeah.
I put him as the most undeserving billionaire because Microsoft just languished, but he managed to become a billionaire out of it.
Yeah.
Stoked.
Stoked. And now he owns an NBA team. It's like, that's the life that I want.
Well, exactly. Look, there are plenty of positive. I mean, Tim Cook and took on the attire. There's always pros. There's always positive stories, negative stories. I think that's something you're always watching. With Amazon, you've seen the founder already starting to walk away. And that's when the interesting thing is, right, with some of these companies, Google's still the CEO, is on the equity analyst briefing every time. Most of the briefing is done by the CFO and other guys in the. They know the business better than the CEO. I can tell you that, right? So there are some guys, like I said, the Google of the Alphabet CEO. He's always on answering question from analysts, but the other guys you just don't even go on. Like I said, I think it's something we look out for. In a smaller company, I feel it's something we pay a lot more attention to because it can often lead to a change in strategy, which could either mean more investments, your return profile looks different, your risk profile looks different. Here, I think the innovation and what we're trying to achieve is largely set. And the other bets, a lot of these companies have this other bets, right? Where they're trying to waste their money on something out of the world. That's still a small part. So it can't eat into what is generally still driving the overall shareholder value.
Well, Zach, there's no doubt that these companies are going to have to continue performing incredibly well to put on another trillion and another trillion thereafter. But it's exciting to think what they will achieve if they do hit that 3, 5, I don't know, $10 trillion company one day. Who knows? But
what's after a trillion?
I don't know. A zillion, isn't it?
Quadrillion?
Look, the returns are. How do you get equity returns? Share price appreciation, capital management, dividends, and thing. At some point, these guys might just go up the ante and become a Telstra. We're going to pay you a 7% yield. We're going to pay you 7%. And you know what? And these guys they're already buying back shares, right? Yeah. Right now, $50 billion of share buyback doesn't make a difference, right? You get to a point where you're saturated. If you had to ask me, there's a couple of ways shareholder value could unlock, apart from just rising market cap, a breakup value. Like I said, that could equate to better companies, better capital management and dividends, shareholder returns, and or they can just continue to just eke out that 10 to 15% per annum at a nice margin.
Can't complain with that. Yeah. Nice one. Well, we are about to hear from Kanish, who's head of distribution at ETF Securities, to unpack the ETF in a little bit more detail. But Zach, thank you for coming in and sharing your time and really highlighting I guess the significance that these companies have in the ETF and why they're important. And, it's really exciting just keeping track of these. And a lot of the Equity Mates community is invested in these companies as well. So we appreciate your time.
Thanks, gents. Appreciate it.
So it's our pleasure to welcome Kanish Chugh to the studio, Head of Distribution from ETF Securities. Kanish, welcome and Happy New Year.
Bryce, thank you for having me, and Happy New Year to both of you as well.
So we've been chatting all things FANG with Zach, and we thought we'd close out the interview to get a bit of an understanding of the actual ETF itself from you. So let's start at the top. Why create an ETF like FANG?
So ETF Securities, we're all about trying to create innovative products and unique products as well. So we launched this ETF. It's the ETFS FANG Plus ETF. So the code is FANG or FANG. So quite easy to remember. We launched it in 2020. So literally just as the markets were starting to drop. So late Feb, early March. And the idea behind it was to give investors an ability to access what they wanted in a larger way. So the FANG ETF gives you exposure to 10 stocks equally weighted in the mega quality, highly innovative, disruptive companies such as Amazon, Apple, etc. But from their perspective, how would you get exposure to those stocks? So an investor they can go direct. They can go directly via a number of different platforms. They can buy one of those names or a few of those names, but they have to choose which of those names. And, we've spoken about single stock risk, and that exists in a big way. And we've seen over the past 12 to 18 months with these names. They could access these names via an active manager that focuses on, quality growth. And there are a lot of them out there. Some get a bit more media than others more recently. And unfortunately, some also underperform the benchmarks. And then you could also access a very broad index such as the S&P 500 or the NASDAQ 100 index. But by doing that, you also get a lot of other names. So the feedback that we got was clients were saying, we want to go overweight these mega quality names. How do we do that? Mega cap quality names. And so we launched this ETF. It's now got, just around 200 million under management. And, it's been around coming up to 2 years now.
So, Kanish, one thing about this ETF that we quite appreciate is that it is equal weighted, which is quite uncommon for Australian ETFs. So explain to us why equal weighting was important when we're talking about these mega cap tech stocks.
It's interesting. I guess, firstly, you call them mega cap tech, and some of them are tech, some of them are not tech. Amazon, it's a consumer company. Tesla, it's an automobile company, but they're all involved in disruption. So tech, I think nowadays is a very loose word. But on the equal weighting aspect, a big part of that is, if you were to market cap weight this index and these 10 names that are in there, Apple would be the biggest weight. Microsoft would be the second biggest weight within this ETF. And they would then dominate the contribution to the performance on the fund. Now, that may be right or wrong, because you may say, well, the biggest company in theory should be dominating. But in an area where all of these companies are innovating and they're disrupting in multiple different revenue streams, whether it be cloud computing, future mobility, gaming, metaverse, esports, or even consumer automation logistics like with Amazon, you want each of those stocks to contribute to the performance. So, in the same way investors look at diversifying their portfolio, an equal weighting approach in certain instances actually allows you to diversify the ETF's portfolio in a much better way than a market cap weighted approach would, which would be the largest name would have the biggest voice. Here, each of the names have the largest voice, whatever their size. And they are big companies anyway. They're 10 of the biggest companies in the world, but still.
So just to quickly whip through them, we've got Meta, Netflix, Nvidia, Amazon, Microsoft, Alibaba, Tesla, Alphabet, Apple, and Baidu. I guess that begs the question, why these holdings? And I think recently you booted out Twitter?
Twitter got booted for Microsoft.
Yeah.
Tesla and Nvidia, how long have they been in there?
They've been in there. The index has been around for over 5 years now. So those 10 names have been there for those 5 years. They were seen as being the most innovative, disruptive leaders in their spaces. And when you think about disruptive trends, so, we have a lot of thematic ETFs. This is a very easy way to access multiple different themes, whether it's the e-commerce, whether it's future mobility, whether it's cloud computing, this is a very simple way to do that.
Kanish, when we speak to you about these ETFs, we like to finish with, talking about what the future looks like for an industry that we're talking about. It's a little bit harder here because these 10 companies are spread across multiple industries in in many countries. I'm going to ask it to you generally. Feel free to take it whichever way you like. What's the future prospects look like for some of these major tech and, huge disruptors?
I think on the whole, a big concern at the moment in the macro environment is rising rates, inflation, and a lot of people are concerned that the impact that would have on growth stocks. And there's a belief that some of these names or all of these names are linked very much to growth. I sometimes would counter that in saying, yes, on companies which don't have strong fundamentals, strong cash balances, strong earnings, strong revenue streams, and diversified revenue streams, you could say that in the long term or in the rising interest rate environment would have an impact. In the short to medium term, there's going to be noise. And we've seen that with some of these names dropping and, starting to have their stock price affected. But in the long term, you look at, say, a Microsoft. Last year, its cloud computing business, which is the second largest in the world behind AWS from Amazon. So Microsoft's cloud business is called Azure. It had a 40% increase revenue on a quarter and topped analyst estimates for the 11th straight quarter at the time of the rebalance in December. It's Office 365 software, which a lot of people are using now post-pandemic because it's a very easy cloud-based solution. We all remember, or not all of us, but a lot of people would remember the CDs that you'd have to go buy. Now it's all cloud-based. That Office 365 is up 23% for the first quarter for the financial year of 2022. And then with Microsoft just standing on that, they recently acquired Activision Blizzard. So they're looking to get into gaming, esports, very much more so, and taking the fight in a big way and dominating that gaming industry. When you think about their Xbox, and that was a $96 billion acquisition, the third largest gaming company in the world. So they're very, very much making some big plays. You talk about Facebook has been absolutely hammered recently. The first time it's seen its active growth rate in terms of users drop since it launched. I think a big thing though with Facebook is in the past, it has gotten out of tricky situations through acquisition. So that will be something to keep mindful of. Its earnings are still quite strong though. And I think that's the other thing when you look at all of these names. A lot of these companies have very strong earnings. Tesla's recently started to turn a profit. Amazon, it has multiple different revenue streams from the largest cloud computing business in terms of AWS to its actual bricks and mortar, bread and butter revenue stream of the Amazon store. I think a key part there is quality. And that's what I sort of try to hone in on is these names are quality industry leaders. They're quality growth names. So yes, in a rising interest rate environment, you may not want to have exposure to quality. But with a lot of these names, you would say, okay, for the long term, and that's the other thing from an investor standpoint, what are you investing for? If you're investing for 3-6 months, well, then yes, you're going to have some extreme volatility with some of these names. If you're investing for 5, 10, 15 years, it'd be very hard to bet against some of these names like Apple has been around for 30 years. Its earnings are growing still, whilst lower, at, sub-teen digits, still double digits, 12%, but still that's very strong considering for a $3 trillion company.
I still, just have to laugh that companies such as Microsoft, Apple, these absolute giants are still lumped into high growth.
Well, they're still growing
crazy.
quickly.
I know. It's crazy what they're able to do.
The one that I think will get the flick next is Netflix. It feels like it is more and more an outlier in that basket of stocks. This index is US listed company, so there's some Chinese names, but they're US listed. Otherwise, you'd think Tencent would get a run over Netflix. But Adobe is 30% bigger than Netflix. Disney is $100 billion bigger than Netflix. Let's get rid of them.
Well, we can take it up with the FANG Plus index.
We'll take it up with the index manager. Yeah, so obviously as an ETF, we simply track that index from it's the NYSE FANG Plus index. We follow implicitly what they do. And yeah, it's been, from our point of view, it's a quarterly rebalance. So every quarter, those 10 stocks get reweighted and potentially they do change. And we've seen that obviously recently. So it is, again, the ETF is also innovating with the times. And the reason why Microsoft was at it was because of its growing cloud revenue business and its esports as well.
Yeah, and I think that's a really important point because Twitter I mean, it was disruptive, but Twitter as a investment hasn't been great for shareholders. I have been a Twitter shareholder for a long time, so I resonate with that pain. But the idea of having the 10 most disruptive companies, but also having people updating that index to make sure they are the most disruptive companies is great. Means you're not stuck holding Twitter like me.
So, Kanish, it sounds like that this is an ETF for people that might not want to be exposed to single stock risk, but want access to these high growth, high tech, high innovation companies that we've spoken about. For more information, and so that people know that it is the right product for them, where should they be heading?
Sure. The best place to go is to the etfsecurities.com.au website. If you click on products at the top, you'll actually see our entire product range, and the FANG ETF is there under what we call the future present range, which has all our thematic ETFs, etc. So that's the best place. The PDS, the TMD, and a few other useful content and articles and insights into the ETF. And also, people can always see it on a daily basis what the weights of those names are. So it's only 10 names, and they don't change much in between the quarter. They don't change at all during the quarters. If they want to see, currently, for example, if I was to just bring it up now, the top weighting actually is Baidu.
Yeah.
It's got a 12% weight in the portfolio. Apple has 11%. Alphabet has 10.8%. So people can actually go on and actually see what's going on there.
Yeah, love it. So head to the website if you're interested and to find out if it is right for you. And thanks, Kanish. We love what ETF Securities are doing, always providing innovative options for the retail investor. And we're back next week with you to also chat about another of your ETFs that is certainly providing a lot of opportunity for our community as well, and that's the Robo ETF. So looking forward to that one. But thanks for your time.
Thanks, guys. I look forward to that conversation.
Hey, thanks for listening to this episode of Equity Mates. We love hearing from you, so drop us a line at contact@equitymates.com, or even better, go to your podcast player and leave a 5-star review. Also, a reminder that the Equity Mates content train doesn't stop when you've run out of episodes to binge. We've got a brand new website, a Facebook discussion group. We're on Instagram, YouTube, and slowly making our way as an influencer on TikTok. Well, that's Ren. So come and say hello and join the community. We'd love to welcome you. Until next time.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.